Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kiryll Prakapenka and Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
We have a new Reserve Bank governor, but don't let that distract you from what matters. This episode, we ponder the implications of the positive inflation data in the US. The key question is the cause behind the disinflation: fall in aggregate demand or normalising supply. The former doesn't bode well for markets. We then discuss the divergence between market fundamentals and stock valuations, with real yields still high but stocks also rising. The market always looks ahead, but how far is too much? Greg then takes us through some gold stocks and in a general discussion of his valuation approach. The takeaway: remember, it's not a stock market, but a market of stocks. Hello and welcome back to, I think this is now the 8th episode of What's Not Priced In. I think it's been 2 months now already and the time has certainly flown by. Welcome again to Greg Canavan. How are you today?
I'm well, Kiryll. Yep, 2 months, mate, and hopefully still going strong.
Yeah, hopefully people are still tuning in, and make sure to leave any comments, and if you enjoy it, give it a thumbs up. But we've got a lot to get through today, and obviously, as we're recording right now, there's some big news out there. By the time this gets uploaded, we'll have a new Reserve Bank governor, and obviously we have a lot of inflation data to get through. But on that, I just have a little quick quote from an equity analyst called James Valentine. I'll just share it with you. And he said, "While the news may be interesting and provide new data points, it doesn't forecast the future, which is the job of an equity analyst. You can waste a lot of time reading stories that don't help pick stocks." So we've been reading a lot of stories, and I'm guessing all of our viewers have also been reading stories, but that's not necessarily what this podcast is all about. It's all about interpreting the data points and looking ahead into the future and seeing what's priced in and what's not. So with that said, we'll turn to the biggest story of this week, which was the US inflation data. And obviously it surprised to the downside. I think over the last 12 months, headline inflation in the US came in at 3%, and that was down from about 4% year on year in May. I think consensus forecast expected 3.1%. So it came in below expectations and it's coming down fast. That said, we also have to consider core inflation. I think the US Fed will look into that more so than the headline inflation. And core inflation was a little stickier. It was 4.8% over the last 12 months, but it was also down from 5.3% in May. And I think when that core data was released, major US indices obviously rose, and I think they touched about 15-month highs. So the market is responding quite well to it, but I think the whole point of this episode is to really unpack what exactly this data means. And now I turn to you, Greg.
Yeah, well, it's a big question, isn't it? And there's no doubt that the inflation data out of the US this week was the driving force behind the really strong reaction that we've seen in the markets over the best part of the week. In saying that, it's in terms of the Australian experience, the ASX 200 is really back to where it was maybe 10 days ago. So there hasn't been any major moves there, but there has been, the biggest move has been in the US dollar. So perhaps we'll just look at that and try to make some sense out of where things could go from here, because I think there's a lot of cross currents going on right now in the markets, and it probably, at times like this, I know what the feeling's like. People can get very caught up in rallies back on, bull markets back, everyone's bullish, but I think it's always worth really examining that viewpoint and not forgetting some of the things that have been going on. So the overall picture that's been going on over the last 12 to 18 months has been interest rate rises. And one of the things we've talked about is the market hasn't been pricing in the higher for longer interest rate regime from central banks around the world. And I still think that story hasn't gone away. And some of the charts I'll show you is just around the positioning of the market and when the positioning is at certain levels, and then there's these surprise data like lower than expected inflation numbers, that positioning gets unwound and has some big impacts on market pricing. But before we get to that, I think one of the most important charts in terms of a change of picture is this US dollar index. And as you can see, in the past few days, it's really broken down to new lows. This is the DXY US dollar index. So it's just really a measure of the US dollar versus currencies like the euro, the yen. And really what this is saying is that because the inflation data has come down so quickly, there's the expectation that other central banks might continue tightening while the US central bank is nearly done. And I think there is probably one more rate rise priced in the US. And then at that point, I think the market's getting more comfortable with the fact that the Fed will go on hold. And, this is a similar story to what we've been talking about over the past couple of months, is that the tightening cycle is probably closer to being done than not. But the next layer of analysis on top of that is how long does the Fed stay on hold, and what is the impact of those past rate rises flowing through into the economy. So that just, and before I continue on with the US dollar story and the impact on commodities, I think it's just worth pointing out that inflation is really a reflection of the demand and the supply story. So the question that I think will be looked at over the next couple of weeks is inflation coming down because supply is increasing and demand is still strong, or is inflation coming down because, yes, supply chains are normalizing still from the supply chain shock of the COVID shutdowns, or is this more driven by a weakness in demand? And if it's more driven by a weakness in demand and interest rates continue to stay high and the lagged impact of monetary policy continues to flow through, you're going to see problems for company earnings in the quarters to come. And I think that's the biggest question. I don't really know, and I don't think the market really knows what the answer to that is. But to me, it's all about risk and reward. And you've got an S&P 500 trading around about 20 times forward earnings. So you really have to ask yourself, and we'll look at some charts down the track on the real interest rates. You have to ask yourself, how much reward are you getting buying the S&P 500 at those levels? You're probably not getting a lot. You really need to be making a bet that real interest rates are going to fall quite sharply in order to justify those high prices. But before we talk about that, let me just finish off with the dollar index, because it does have big implications for the commodity sector. And obviously commodities generally trade opposite to so when the US dollar's weak, commodity prices tend to do well. So I thought it's worth just highlighting how some of the key commodities have done in response to this sharp fall in the US dollar. And it's probably a bit surprising to see that, you've got gold prices still looking quite nice here. Gold's making, trending up higher nicely, but it's still in this consolidation mode after, quite a big correction here over the past couple of months. It's had a good little move over the past few weeks, which is good to see. But, it's not breaking out to new highs. It's not hugely bullish. This is just an ongoing upward trend, which is good to see, but it doesn't really match the solid breakdown you're seeing here in the US dollar index. It's a similar story here if we look at copper. Copper's certainly looking a little bit better than what it was a few weeks ago, or it was turning back down there. You're making higher lows, which is good to see. This medium-term trend is still down, but it is possibly in the start of a new upward trend here. But again, compared to the highs that we saw back in early 2023, we're nowhere near up at that level yet. Again, similar situation. This is the silver price. Silver's had a really strong rally, and silver obviously is a really sort of high correlation play to weakness in the US dollar. So no surprise to see silver prices surging there. That's good to see, but again, not up near those levels that silver found itself just a couple of months ago. And here we've got, this is the US crude oil price, WTI futures. Again, had a really good week on the back of that US dollar weakness, but still in this longer term downtrend. And a similar picture there for Brent crude, which is the international oil price benchmark. So this could be the start. Like if you look at both oil prices, they've been in this bottoming range here for the past 3 or 4 months, which is good to see. It's tried to sell off into those levels and found support, and now it's rallying back higher. So this is certainly a good sign for the oil price, and we've gone through this really big sell off, this bottoming formation, and this if we can make a higher low here in the months to come, and that's going to be really bullish for oil. And the good thing is a lot of the oil stocks, especially on the Aussie market, have held up really well throughout this sell-off, which just gives you an indication of the underlying earnings and the valuation for that sector. So that's good to see. And one other thing I think is worth pointing out, just on the positioning of the market, which is again important to understand. If we look at, so we do this every week just to give you an idea of where the sentiment is in the market, and still this is the CNN Fear and Greed Index, and still we're in extreme greed mode, and we've been there for well over a month now.
Very greedy.
As you can see, we've got extreme greed, a week ago extreme greed, a month ago extreme greed, a year ago we're in fear mode. So that's been in that range since early June, so it's over a month now. And on the flip side of that, this is quite interesting. This is the from the Commitment of Traders report. This is the S&P 500 net speculative position, and throughout the bear market of 2022, you can see that traders were positioned bearishly and obviously profiting from those bearish bets. But even as the market was rising throughout the latter half of 2022 and into 2023, these bearish bets got higher and higher. And as the markets in the US have continued to rally, obviously these short traders are getting killed. And in the last couple of weeks, this peaked in June, and in the last couple of weeks, these bets have started to be unwound. We're going to get new data on this tomorrow, so that will reflect this week's big rally. And I'm assuming that you're going to see a big fall in this positioning, and we might just update everyone on that next week, because the argument there, and let me go back to the chart of the S&P 500, because the argument is, if this is really just a change in positioning that is behind this rally, then you wonder how much more how much it's got in the way of legs. So obviously this is a very bullish looking chart. So it's gone against the short positioning. And I suppose you have to say to yourself, well, how much of this is fundamentally driven, and how much of this is driven by short covering because traders have just been caught short? And again, there's you can't complain, you can't deny that this is a very bullish looking chart. It's breaking out to new highs. Same with the Nasdaq, new highs again here. But again, combining valuations and combining sentiment, my question would be: is it worth getting all bulled up and excited about a broader market rally when a lot of that is potentially to do with unwinding of short positioning and very bullish sentiment that's been that way for the better part of a month? And it comes back to, how do you sort of position for this, or what do you do as an investor? And in my view, nothing has really changed, and we're looking at. Let me just point out one other move here. So this is the bank index in Australia. So the banks are still trending lower. The banks aren't really doing anything. Yes, they've rallied a little bit the last couple of weeks. And if we look at the ASX 200 in general, it was looking pretty dicey here just a week ago. It had dropped out of this larger consolidation range. And now we're just back in the consolidation range. We're recording this on Friday morning, just before the market opens. So we're obviously going to get another strong day today. And, does it break out of this consolidation range, or just does it stay in here for a little bit longer? So I don't think people should be getting too carried away with this rally. Clearly, equity investors have said weaker inflation is bullish for equities, but at the end of the day, we've still got interest rates at a pretty high level. We've still got central banks that are wanting to see inflation back down into that 2% range before they start to even think about cutting rates. So my conclusion is it's the same as we've been talking about for a while. What's not priced in is higher for longer interest rates, and equity markets are potentially getting too excited on the back of weaker inflation numbers, thinking we're off to the races again. Whereas I would argue that inflation is coming down because of weaker demand, not necessarily because of normalization of supply and ongoing strong demand.
Yeah. Well, I think everyone, the market is clearly forward facing. It looks ahead, but the question really is, how far ahead is it looking? And it seems like it's sort of already pricing in that maybe the central banks across the world are going to pull off a miraculous soft landing, and that real yields are going to come down. And I think we talked about this last week, and you've written about this to your subscribers as well. The relationship, or the breakup in the relationship between real yields and stock prices. And I don't know whether Morgan Stanley or not watches our podcast, but they released a note as well, similar to what you've said. And
and suspiciously just after too.
Exactly. The timing was very suspicious. But I'll read the quote, and it said, notably, current price earnings ratios have decoupled from one of their most fundamental drivers, the 10-year US Treasury real yield. Now, this rate is the basic building block for discounting future cash flows, especially for long-duration growth stocks. The current 10-year real rate is in line with last October's cycle high, which correlated with a stock market trough and a PE ratio below 17. Today's forward PE ratio is of 20, and therefore looks completely unjustified. That's pretty strong.
Yeah, well, as I think it's similar to what we basically said last week. And real yields probably don't get enough attention in the marketplace. They are effectively the real cost of money, and it has to be the foundation for how you value things. So going back to what your point, I think the market is in its ongoing bullish way, looking through whatever downturn is going to be the result of this tightening phase, and looking over the valley and saying, well, it's going to be sweet again at some point, which is, I guess it's the way the market works. And one thing I'd want to point out is that you don't want to become too ideological in your view. You don't want to just sit there stubbornly and have your view, and you need to always respect what the market's saying. And on the other hand, you need to try to work out whether the market's view is a realistic interpretation of what the fundamentals are. And the fundamentals sometimes can be interpreted through your own lens. So you can look at, pick and choose whatever fundamentals you want and say, well, that doesn't match with my view, therefore I'm going to sit in my bullish or bearish corner. And going back to the real yield, that is one of the key foundations for valuations and for the price of money, effectively. So if we look at that, and I'm just going to update. So we've updated these charts that we showed last week on the real yields. And in the black, you've got the real yields. And when we spoke about this last week, real yields had plunged down here. And I think we sort of said at that stage, look, I'd be very surprised if the nominal yields, because this is when nominal yields were right back at their October 2022 lows. I think the US 10-year yield peaked at 4.22% in October. And this time last week, it had just got to a point where it was just over 4% again. And we talked about bond funds probably being a good buy because of that sort of reaching that level again and testing those lows. And I think what we've seen here is a bounce back in the real yield, a fall in the real yield, and that what's been behind that is the fall in nominal bond yields. So you can see this separation here. This is the S&P 500. If the S&P 500 were to catch up to this correlation that has been pretty tight with up until the lows of October last year, you'd see a fall of nearly 18%. Now, I'm not saying that's what you can expect, but I guess what I'm saying is the market is pricing in a real yield that is much closer to being up here than what it is down there. And I'm not sure the only way real yields can fall that much is if the economy slows down to an extent that sees nominal yields fall considerably. And I'm not saying that can't happen because obviously high interest rates are going to continue to bite. But if the economy were to slow that much, then clearly that's going to have a big impact on corporate profit growth, which means justifying those levels in the stock market is harder to justify. So I'm not suggesting real yields are going to go up here, and I'm not suggesting the S&P 500 is going to go here, but maybe meeting somewhere in the middle might be a more reasonable way to look at things. And again, going back to risk and reward, to me, this is not a good risk and reward area to sort of look at or get into the market. Similar picture with the NASDAQ, except we've just got a larger disconnect here. There's a 23% difference between those two asset prices. If we look at gold, it's slightly closer. The gold price is about 7% and a bit higher than where real yields suggest they should be. And the S&P 500's, the ASX 200 has got a reasonable correlation with the US real yields as well. And both of those asset markets bottomed around the same time last year. And again, the ASX 200 has really moved away from that, similar to the US indices. But again, the disconnect's not quite as bad. You're looking at just a bit over 9% there. The other thing I wanted to point out, and one of the services that we have at Fat Tail Investment Research is an algorithm that runs the copper gold ratio, and the copper gold ratio here is in red, and we've just overlaid that with the real yield or the tips, just to show the correlation and explain what the copper gold ratio is about. So when the copper gold ratio is falling, it's really the market's way of saying that defensive assets or a defensive positioning is favored over a expansionary or economic growth type of vibe. So obviously when copper's rising, that's pretty good for industrial growth, economic growth around the world. And when copper is falling, obviously that puts question marks over that bullish view. So when you've got a falling copper gold ratio, that's generally negative for asset markets. Rising copper gold ratio, generally good for asset markets. And just in the last, let's say it peaked here in February 21, and then we've seen a big fall again. And I think behind that is the whole argument around China and the reopening phase. And I think there was a lot of optimism here around China's reopening and the effect on the global economy. And around this point, obviously, it got to a situation where the market realized that the China reopening wasn't going to be as bullish as previously expected. So you saw the copper gold ratio fall again, and we've just seen a little bit of a pickup in that over the last couple of months. But the correlation here between copper gold and the real yields is reasonably good. So I guess what I'm saying is both of these indicators are at relative lows, whereas you've got the S&P 500, the ASX 200, the NASDAQ, all that sort of stuff up around these levels. And there's just that disconnect there that suggests as an investor, you should probably be a little bit cautious about this latest rally, should be a little bit cautious about thinking, oh, is it time to get back into the market? I'm going to go buy some index funds. I still think we're firmly in a stock picking market. I'm not saying that it's bearish overall. I'm just saying that the real opportunities out there are in individual stocks that require proper valuation analysis research, trying to work out which ones are in sweet spots, which ones are overvalued and potentially risky, rather than just being all out bullish on the market or bearish. So not to me, it's not an easy market to try and work out what's going on, especially when you get 3 or 4 days of really strong price action. You've got the US indices looking really bullish, but I would just question as a general trend of whether that bullish trend is going to continue.
Yeah, and I think from that Morgan Stanley note as well, it said that this time may be different, but market fundamentals should not be this contradictory. So whether the bull run has legs or not, it should still all hang together. The real yield should still have a strong relationship to asset prices. So we'll
Absolutely.
definitely see what the next 6 months have in store.
I was going to say that that fundamentally should be an anchor for stocks, indices in general. In the same way that when a stock price moves well above its moving average, the moving average does anchor that price back down towards it, even if in the short term. So in the short term, I would say that the US indices are quite stretched. And a lot of that is to do with this unwinding of previous bearish bets. And this time next week, we'll show an update on that positioning and see whether it has been unwound or whether people are putting more bearish bets on and there's more pain. But people talk about this pain trade, and I think the pain trade is obviously being short and expecting the market to go down. And as that has not bared fruit, then those traders are really getting punished and they're unwinding those bets. That's pushing prices higher. You've got sentiment levels that have been in the extreme greed range for a month or so. Again, you put all these things together, and that's for an investor, it's not good long-term risk reward. Trading is different, and I'm not much of a short-term trader, never really have been. I'm sort of always looking at this from longer-term investment positions. And that's where I would be cautious on markets and bullish only on individual stocks.
Yeah, I think if the relationship between real yields decouples from stock valuations, there would be a whole rupture in fundamental analysis, because we definitely rely on the real yields to anchor valuations and the whole discount rate and everything.
To be honest, I don't know what I'd do, Kiryll, if that happened. I'd be very confused and wouldn't know how to interpret that. So we'll see.
You'll become a momentum trader. You'll start trading. You'll become a trader.
Yeah,
but,
dartboard trader.
Yeah, dartboard trader.
Well,
just breaking news as well. With Michelle Bullock has now become the Reserve Bank governor. So I think she was the deputy governor, and so probably nothing really is going to change. I think you texted me beforehand saying that they're all bureaucrats, so it's all going to be the same.
Well, okay. Let's be honest. The 3 people that were up for consideration, I think Michelle Bullock's been at the bank since 1985.
Okay.
The other 2 are lifelong bureaucrats. We're really not getting much different to what we've had. So there's going to be a lot of stuff written by it, and sure, the individual is important that leads a bank. But generally, these appointments are designed to not change anything.
Yeah.
So I wouldn't say I don't care or anything like that, but I would say it's really not that important.
Yeah,
I mean, she's not going to come out and start cutting rates or raising rates. There's the whole idea behind these changes is to make sure there's as little change as possible.
Exactly.
So, as you were.
Exactly. Well, you've heard it here first. But I think with I just maybe had a broader question for you in terms of what your views are of this market, because I think there's so many different contradictory messages. So I think the real yield is decoupling. I think the market breadth itself is quite narrow. So some tech stocks are surging, and most of the other stocks are really going nowhere. What are your views of the market right now? Are you confused? Are you excited? Are you optimistic? Cautious?
I won't say cautiously optimistic. That's probably the worst cliche
Cliche.
ever
Yep.
invented in financial markets. I am confused, but the way I sort of deal with that confusion is that I always look at markets from two different perspectives. You've got the fundamental view,
Mm-hmm.
and then you've got the technical view. And the
Mm-hmm.
technical view is just the charts.
Yep.
And I find that really valuable to look at that, because the charts are really just a window into the psychology
Yep.
of the market. So by having charting analysis mixed with fundamental analysis,
Mm-hmm.
you can put those two things together and things become a lot, not necessarily clearer, but you gain a bit more perspective from that. So if you're looking at markets purely from a fundamental perspective, you're confused because you're saying, I don't understand. And interest rates have been rising for the past 18 months.
Mm-hmm.
You've had bank failures in the US. The economy's clearly slowing down. Yet the S&P 500 and NASDAQ are nearly back at all-time highs after defying all predictions throughout 2023 and rallying. China's slowing down. I think we had trade data yesterday from China showing trade import and export volumes have slowed and were below expectations. So on the one hand, fundamentally, you've got a slowing global economy and you've got rising markets. When you look at it from a charting perspective, you just see those trends and you think, okay, well, that trend is bullish. So you merge those two together. And this is what I was saying before. You come to a conclusion that there's no high probability trade here. Yep. Because markets are very bullish in terms of their charting technical picture, but also from a fundamental picture, there's not a lot of risk and reward. So when you get those two conflicting signals, I just tend to say, well, you know what? There's not a lot to be pessimistic about, but there's not a lot to be excited about either. So you don't necessarily need to do anything. And this is where I was saying, you look at individual stocks and you say, okay, is there an opportunity in this individual stock? Is it oversold for some reason? Has it been neglected for whatever reason? So that's where I'm focusing my attention on the individual stocks and not focusing too much energy on trying to work out where the market is going, because there are conflicting signals. And to me, that's just a low probability trade, a low probability outcome. There's no point punting on it. If you look at the ASX 200, it's gone sideways for 2 years. And the price action of the last couple of days has not changed that at all. We're just back to where we were 10 days ago. Yeah. So you can get yourself really focused on the latest news and what it means, but sitting back, bigger picture, Michelle Bullock's not going to change the interest rate outcome anytime soon. The interest rate in Australia may or may not go up one more time. I know the data from the US this week was at least positive on the fact that rate rises won't be more excessive than what was previously thought. But the reality is that rates are going to stay high for longer, and that's not, and the market's not pricing that in. And I think that's where I'm focused on understanding that, there is probably risk from a broader market perspective, and then just focusing on the opportunities and going back to the very start, looking at the DXY, the dollar index, and the breakdown there, and the fact that commodities have been underperforming for so long. I think in select commodities, I think that's where you can really look for some opportunities in the months to come. Because if this breakdown in the US dollar index is sustainable, then to me, this whole bear market, or this cyclical bear market that we've seen in commodities over the past 6 to 12 months, could well be over. So we're looking at energy, we're looking at the ongoing rises in the gold price, copper, nickel, all those sorts of stocks that have been under the pump. That could be close to the end of the bear market for that sector. So that's something that I'd be looking a bit more closely at.
Yeah, and I think we'll maybe get into a quick discussion of gold stocks soon. But I just wanted to reiterate your message that even though central banks are probably near the end of their rate hike cycle. They aren't going to just quickly unwind all of that back. It's going to remain like that for maybe a year or two. And I think now this message is sort of percolating through the media, and I think now there's phrases like the last mile of inflation. So to get inflation down from 3% to 2%, which is the target range, is going to be like the final hurdle. And I think the sort of the analogy is to the last mile delivery, where I think the hardest part of delivery is to get the package from the last mile from the warehouse to the store. And now they're sort of saying that this is sort of the analogy to inflation. Yes, inflation has come down to 3% in the US, but a lot of economists are now saying it's going to be quite tough and quite a long battle to get that down to 2. And especially with the core inflation reading, it's still at 4.8. So the less volatile inflation out there that sort of felt by everyday people is still quite high, and so it's going to take a while to bring that back down.
Yeah, you're exactly right, and it goes to what we're saying. The market's just jumping ahead and saying
Yep.
that the inflation battle's won. It's back to 2021. But I think we've definitely seen a regime change over the last couple of years. So we need to keep in mind that that story hasn't gone away, and the only way you're going to get inflation back under 2% in a really short time frame is to effectively put the economy in a recession. Again, that's not good for company earnings, and buying those earnings at 20 times in the US, it's a little better equation in Australia, but buying those earnings at that price, again, low probability bet that you don't really want to. It's just a bet you don't need to make, so don't need to worry about it.
Yeah. Well, now maybe we can turn to gold stocks, and you've been saying that you were picking up some interesting charts in terms of some gold stock performance over the last few weeks.
Yeah, I thought. I mean, we talked about gold in an episode a couple of weeks ago, just highlighting the relationship just here between the fact that real yields had been going lower and the gold price hadn't been matching that. So I think at the time I said not overly bearish on gold, but just cautious and mindful that there could be a sell-off to catch up with that. That obviously hasn't eventuated. And just when I looked at the performance of the ASX 300 so far this week, out of the top 20 performers, 11 of them have been gold stocks. So I thought it'd be just worth running through those quickly and just seeing. And we talked a minute ago about the charting outlook for stocks, whether stocks are in uptrends or downtrends, whether they're just going sideways. All these things are important to work out short-term moves and see whether those short-term moves have actually changed anything in the overall trend or whether it's just more of the same. So I thought we could just run through those 11 gold stocks that have been the best performers this week. So I've got Capricorn Metals, really good week, but it's still sort of trending down to sideways. I would just say this is in a consolidation range, so not much change there. De Grey Mining had a really good rally from being oversold. Again, not really changing anything in the overall picture at the moment. The only one that's really broken out to new highs is Bellevue Gold. So that's a really, really strong move. Obviously, it's got to probably come back and consolidate that move, but that's a good looking chart. Regis Resources, again, it's sold off the past couple of months and just really rallying strongly from that sold off position. Westgold Resources coming back up to its highs that it reached in May. So whether it breaches that today remains to be seen. Evolution Mining, again, decent sell-off here over the past couple of months. Good reaction from those oversold levels. Resolute Mining, more of the same. WAF again, this is West African Resources. Big sell-off here over the past year or two, and just rallying again from oversold levels. Same with Perseus Mining, another African miner. Same with Silver Lake Resources, rallying off oversold low levels, and the same with Red 5. So as much as the rally in the gold stocks has been positive this week, and it's been obviously the best performer in terms of sectors, hasn't really changed much in the big picture. If you were seeing gold stocks break out from multi-month consolidation periods, all that sort of stuff, then that's where you say, okay, look, this move potentially means something, and this move could mean something. But looking at it right now, it's just like, well, okay, well, they're sold off for the past couple of months. Perhaps as a lot of people were getting bearish and looking at putting on short positions and expecting further falls. That didn't happen. You're seeing a lot of those bets being unwound, and that's where you're getting the reaction. So, as I said a couple of weeks ago, I'm long-term bull on gold. Got about 5 or 6 gold stocks in our client portfolio. Haven't sold any of those in the correction. Looking for times to get back in. I think we put a buy on Gold Road Resources a couple of weeks ago when it came out with a weaker production report, and its share price fell quite sharply. So just looking at those moments or sharp sell-offs to buy the dip effectively. But I think you want to see a little bit more positive action from the gold sector before getting too excited.
Yeah. And I think maybe we can maybe end on a little discussion, I think, on how your valuation approach. And I think you've already mentioned, I think it's really easy to get bogged down in the macroeconomic news and just looking at the front page of a Wall Street Journal or something and see that the NASDAQ is just continuing to surge and inflation's coming down and is this the bull run or not? But at the end of the day, if you're not a passive investor, you'll have to choose individual stocks. And if you choose individual stocks, you have to sort of appraise their individual businesses. And some businesses are maybe more exposed to business cycles more so than others, but there are businesses that are sort of maybe more resilient, and you can sort of forget about the wider economic picture and just be an individual stock picker. And I think maybe sometimes that is so maybe overlooked in the wider press because the focus is so strong and so strong. Yeah, it's so strong on the macroeconomic forces. But like you always said, you don't necessarily have to think of it as a stock market. It's a market of stocks. It's just investing in businesses, and some businesses may do well regardless of what's happening in the wider economy.
Yeah, and it comes down to what is the market pricing in for that business, and has it become overly optimistic or overly pessimistic about its prospects? And what I like to do is look for stocks, good quality stocks that might have fallen 30, 40, 50%. And then because they've disappointed so many investors with that fall, they've just sold it. It's gone out the back door. It's not on the front page of the AFR anymore. It's not in any page of the AFR. It's almost a discarded story that people have forgotten about. But at the end of the day, it's still a business. It's still generating cash flows and profits. And one of the key things I look at is profitability, so return on equity. And I've got obviously a valuation approach. I won't go into the details here, but if you do a valuation on a reasonably conservative discount rate, and I always use as a starting point 8%. So I'm saying I need an 8% return from this investment to make it stack up. Then if you get a good result from that, and you think there's a lot of pessimism priced in, I also look at the charts to make sure that you're not buying into a well-defined downtrend. You want to sort of see a bit of stability in the charts, or maybe a bit of an uptrend taking place. Then that's always for me. That's a good sign that you might have a good contrarian opportunity. But one of the things I don't want to do is invest in popular stocks, because often that's a way that some people invest and they do really well out of it. But I always try to go for the unpopular stock, because that's where you find value. So perhaps we can do an episode one time in the weeks ahead on that type of approach and get into the nuts and bolts of the valuation. To me, sometimes the crowd split between putting them to sleep with that type of talk, or getting a lot of interest out of it. So
that's
look,
exciting.
if you're interested in that discussion, maybe let us know in the comments, and we'll see how we go.
Yeah, and please do say that, because I would definitely want to do an episode like that. So if the crowd responds well, we'll definitely do it. And then maybe I'll talk about the dividends discount model that you seem to hate so much.
I keep shutting Kiryll down. He wants to talk about dividend discount model, and always saying, "Nah, mate, it's not relevant." Only because I'm not a fan of dividend discount valuations.
Maybe there'll be an special episode with your return on equity model versus the dividend discount model, and we'll see who comes
Or
out on
maybe
top.
we could do late nights with Kiryll on the dividend discount model for the hardcore listener.
It's just an audience of one. It's just me.
Exactly.
But with that said, I think we've covered quite a lot of ground there. And so maybe just to round off, what's your biggest message of this week for what's not priced in? I'm guessing it's got to do with real yields and the disconnect between the fundamentals.
It's the same story. Real yields are disconnect, and the fact that the market is thinking rates, the higher for longer story for rates, aren't going to have an impact. And I think higher for longer is definitely a risk. And the only way that rates don't stay higher for longer is if economic weakness kicks in much sharper than expected, which is not good for company earnings. So I can't see a lot of reason for continued upside, potentially unwinding of those short positioning bets. But apart from that, I would just leave by saying good news on the inflation front, but don't get too excited about it being the reason for a new bull market.
Yeah. So you're cautiously optimistic?
Optimistically cautious. I don't know. I just hate that phrasing. So I'm just looking for good stocks at good prices, Kiryll.
Yeah, exactly. That's the eternal message. Well, with that, we'll leave it to it, and hope everyone has a good day.
No worries. And just lastly, because we operate on the YouTube thing, the algorithm does like thumbs up and comments, and it does say, "Oh, people are listening to this podcast. We might put it in front of other people." So just ask a favor: if you are listening and you did enjoy it, give us a thumbs up and put in a comment to say whether you want Kiryll's dividend discount model.
Yeah, exactly. Please do. Please do.
All right. But thanks for listening.
Yep. See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.